Collapse File Number 10. Subject: Long-Term Capital Management. A hedge fund of Greenwich, Connecticut. Principals: 16 partners, among them 2 Nobel Prize winners in economics. Position: $125 billion in assets, balanced on $4.7 billion of capital. Cause of death: a mathematical formula that proved that none of this could ever happen. This is the Collapse Files. Because on the evening of September the 23rd, 1998, the chief executives of 14 of the most powerful banks on earth sat around one table on the 10th floor of the Federal Reserve Bank of New York. They were rivals. Several of them despised each other, and they had been summoned, like schoolboys to the headmaster's office, over a fund most of the public had never heard of, a fund whose failure, they were told, might take every one of them down with it. This is the story of the smartest fund that ever existed, and the 6 weeks it took to die. John Meriwether was the most respected bond trader of his generation. Quiet, private. At Salomon Brothers, his trading desk was, at times, more profitable than the rest of the bank combined. Then a rogue trading scandal at Salomon, not his, but on his watch, pushed him out. In 1994, he struck out on his own, and he didn't hire traders, he hired professors. He set up not on Wall Street, but in Greenwich, Connecticut, a quiet town of hedge funds and old money, an hour from the noise. The distance was the point. This fund would not shout into telephones, it would compute. Myron Scholes, of the equation that bears his name. Robert Merton, who took that mathematics further still. Between them, their equations had priced the modern options market, the numbers running underneath every trading desk on the planet. And David Mullins, recruited directly from the vice chairmanship of the United States Federal Reserve. Academia, the central bank, and Wall Street's sharpest trading desk, all under one roof. The press called it the Dream Team. The minimum ticket was $10 million. The fees were extortionate. The fund refused to tell investors what it actually traded. They queued up anyway, $1.25 billion at launch, one of the largest debuts in hedge fund history. And the machine simply worked. Roughly 20% the first year, 43 the next, 41 after that, barely a losing month in 4 years. Every morning, the models measured the fund's risk to the decimal. On the worst day the mathematics could seriously imagine, the fund stood to lose perhaps $35 million. Hold that number, you will see it again. Now the twist, because the trades themselves were boring. Long-term wasn't making bold predictions, it was collecting crumbs. Find 2 nearly identical bonds whose prices have drifted a fraction apart. Buy the cheap one, bet against the dear one, and wait for the gap to close. The models said the gap always closes. Profit per trade, pennies. The genius was never the bet, it was the borrowing. For every dollar of its own capital, long-term borrowed roughly 25 more, and the banks lent it nearly free, desperate to be close to the geniuses. 25 to 1 turns pennies into fortunes. Traders had an old name for this strategy, picking up nickels in front of a steamroller. And there was a second problem, quieter than the first. Every desk on Wall Street had reverse-engineered the Dream Team's trades and copied them. The whole street was in the same positions. The exit was crowded before anyone needed it. October 1997, Merton and Scholes are awarded the Nobel Prize in economics. The theory at the heart of the fund now carries the highest stamp of approval human civilization can issue. 2 months later, the partners did something extraordinary. They forced $2.7 billion back into their outside investors' hands, returned it unasked. Not generosity, they wanted the returns for themselves. The investors were furious at the eviction. It would prove the luckiest eviction in financial history. Because the fund kept its positions and shrank its capital, so the leverage quietly climbed. And beneath the balance sheet sat derivative contracts, side bets stacked on top of other bets, with a face value above $1.25 trillion. Trillion with a T. That same year, Asia's markets convulsed. The models absorbed it, the partners barely flinched. Confidence hardened into certainty. But in the spring of 1998, something the models hadn't priced began to happen, nothing in particular. No crash, no headline, just the gaps, the ones that always closed, drifting wider week after week, and refusing to come back. In May and June, the invincible fund quietly lost double digits. The steamroller had appeared on the horizon. Then, on August the 17th, 1998, Russia did something the models had assigned almost no probability at all. It defaulted on its own domestic debt. Panic doesn't read probability tables. Investors everywhere fled to the safest assets on Earth and dumped everything else. Every gap the fund had bet would close tore open at once. Dozens of trades in dozens of markets, unrelated by design. The panic revealed them to be one trade, and it was losing everywhere at once. And in July, a detail almost nobody noticed at the time, Salomon itself shut down the very desk Merriweather had built and began dumping the same positions into the same thin market. The copycats were leaving first. Friday, August the 21st, $553 million gone in a single trading day. Remember the worst day the mathematics could seriously imagine, 35 million. This was 15 of those at once. By the end of August, $1.85 billion, nearly half the fund's remaining capital, was gone. In 1 month. Merriweather worked the phones for rescue money, banks, billionaires, anyone with a spare billion. But every call told the street the great fund was wounded, and dealers began trading against positions everyone already knew by heart. On Wall Street, blood in the water is not a metaphor, it is a price signal. By late September, the fund's capital had burned down toward $400 million, while the balance sheet was still the size of a small country. The leverage the partners had chosen at 25-1 had drifted, unchosen, past 100-1. Every further tick down was now amplified 100-fold. Exhibit A, a single fax, transmitted on the morning of September the 23rd, 1998. Sender, Warren Buffett. The richest investor alive, with the IG and Goldman Sachs behind him, offering to buy the entire fund. $250 million for the partners' stakes, $3.75 billion pumped in behind it. The dream team would be erased from their own fund. Buffett, by most accounts, was on a boat in Alaska with a patchy satellite phone. The fax gave Merriweather until 12:30, less than 1 hour, to sign away his life's work. 12:30 came and went. Lawyers, structure, pride, the deadline expired. The last private lifeboat sailed. Which is how we arrive back at that room on the 10th floor of the New York Fed, 14 banks, 1 evening, and a number on the table. $3.625 billion to take 90% of the fund and unwind it slowly before it detonated. Bear Stearns, the bank that processed the fund's every trade and was already demanding an extra $500 million of collateral just to keep doing it, put in nothing. The others glared and paid, 11 banks at $300 million apiece. Lehman Brothers, already wobbling itself, managed only 1/3 of a share. The deal closed around 6 in the evening. Note what the Federal Reserve contributed, not $1, the Fed lent the room. Why did the Central Bank of the United States care about one private fund? Because of the web. Over $1 trillion of contracts spun into every major bank, and a default would have dumped all of it into a market already in freefall, at fire sale prices all at once. Regulators later concluded the fund's failure could have posed serious risk to the financial system itself. Translation: the steamroller wasn't chasing one fund, it was chasing everyone. Here is what actually killed the mathematics. The models assumed the market was something the fund observed from outside, but at $125 billion, with the whole street copying it, long-term wasn't watching the market. It was the market. When it needed to sell, the only buyers were the people selling alongside it. That October, the Fed cut interest rates in a surprise move, and markets slowly exhaled. The system had held this time. The fund itself was wound down quietly under its new owners. The 14 banks got their money back. By early 2000, long-term capital management ceased to exist. Now the tally, the partners, the smartest men in finance, had kept their own fortunes inside the fund, roughly $1.9 billion of their own money, erased. And the criminal charges, none, nobody stole, nobody lied. Every catastrophic decision was legal, peer-reviewed, and Nobel approved. The mathematics was simply wrong about the world. Merton and Scholes went back to teaching, their Nobel Prizes intact. The formula still runs underneath every options desk on Earth. The prize committee does not ask for medals back. John Merriweather launched a new fund within a year, running, he said, similar strategies with less leverage. It died in the 2008 financial crisis. 10 years, almost to the week, after 14 bank chiefs saved the system in one room, the same banks gathered in the same building over a weekend in September 2008 for a firm called Lehman Brothers. The playbook they reached for was this one. The formula said it couldn't happen in the lifetime of the universe. It took 6 weeks.